Hello again there, ladies and gentlemen. Nathan Bluestein with Pivotal Directions. Something I want to talk about here that I don't know if a lot of people understand, that institutions are the ones that drive the market. Okay, that's important to understand, because if you don't understand what they're doing, you could be playing against them, and that's something you don't want to do. The institutions control, especially futures, they control the market. And I want to talk a little bit about how they work. Okay, so let's say, for example, I'm going to use an analogy that we would do, and bear with me because I'm going to do this as we go along live here. So let's say people like us, we go out and let's say we're going to buy a pair of socks. Okay, we go to a store and we're going to look to pay about $10 for a pair of socks. I'm just throwing a number out there. We're going to buy maybe one pair, two pair, even up to 10 pairs of socks. And we're going to be paying, let's say right around $10 a pair of socks. I think that's, for our analogy, that's what we're going to use. So we're buying 1 to 3 pairs, 5, even 10 pairs of socks, and we're going to get them for $10. Okay, now we're going to relate this to the price of the market. Fair value of the market's $10, right? That's what we're buying them for. Now, our institutions, we're going to use an analogy here, but let's say our first institution, or our first, we're retailers, so we'll say wholesale. Our first wholesaler, our institution, let's say they're, I'm in Michigan here, so I'm going to use a Midwest, even Michigan-based company, Meijer. Meijer, they have, dozen stores or so, maybe a little bit more throughout the Midwest region, but a regional store. I'm sure they're expanding. But let's say they want to, they're going to buy enough socks to stock all their stores from the sock supplier. Again, remember, we're going out there, we're shopping, and we're going to be paying about $10 for a pair of socks. Okay, but now Meijer is going to come in here and say, listen, I'm willing to buy 10,000 pairs of socks. So with the demand that they have, they're going to be able to get a better price on those socks. So let's say they say, all right, you know what? I know that all our individuals are out there buying for $10, and we're going to be selling them for $10. That's what the price we want to sell them at. But we're going to buy them for 10. We're buying 10,000 pairs. So we're going to be buying socks for, let's say, $6. We're going to get a better price on them since we're paying 10,000. Now, there's another level of institutions out there. And let's say, the analogy, we'll use them as Target. Now, Target's national. I believe they're a little bit international too. I believe they're in Canada as well. But they're, a bigger institution. They have more stores than, for example, Meijer here. So you know what? They're interested in buying socks as well to sell in their stores for $10. But they're going to buy 50,000 pairs of socks. Okay? Now, since they're buying 50,000 pairs, they're going to want a better price than all of us buying 135 pairs of socks. They're going to want better than Meijer, who's only buying 10,000 pairs. They're buying 50,000 pairs. So they want a better price. And let's say they want it and they get it for $3. They get them $3 a pair. Now let's say there's that third area institution, that third buyer who's going to stock their stores. And let's use the analogy of Walmart. That's the example we're going to use here. Walmart, the big institution. Walmart's international. They're, stores everywhere, huge. So they're willing to buy 100,000 pairs of socks. 100,000 pairs. So wouldn't it make sense that they want a better price than all of us here? Obviously a better price than us, a better price than Meijer, a better price than Target. So let's say they're able to get it for $1. This is how the institution's set up. So how we relate this to the market. So for example, the price $10. Okay, price moves down to $6. This is where we see Meijer coming and buying, right? And what do they want to sell it for? They want to sell it for $10. So this is how we see a price movement. Now again, we look at candlesticks. I'm going to show you an example here in a minute. But then now, okay, now they're able to sell. Price moves back down. Hey, listen, we're back down into $6. Guess what? Meyer is interested in buying socks again. So we move up. Now, once they see, Meyer is coming into this thing, and we see our bounce off of, we can call this a support area. Now Target's coming in and say, listen, hold on, I'm ready to buy my socks now. I'm ready to buy my socks. So they move price down. They're able to buy socks. Their socks at $3. And what do they want to sell them for? They want to sell them for $10. Now price isn't going to usually shoot straight up to 10, but we might see it come back up here. Remember, what was support? Now it's going to become resistance, come back down. Maybe they only got filled on 25,000 pairs the first time because, again, there still has to be supply and demand. So even though the demand is 50,000, they were buying 50,000 pairs. If there's no one there to sell them 50,000 pairs, then they're going to have to wait. Maybe they only filled on 25,000, so it comes back down. They get filled on 25,000 again. What happens? We move up. However long it takes there, and then they sell it at $10. That's their price. Comes back down again. What happens? Oh, okay, this triggers Meyer's buying area. Meyer wants to buy. They try to sell it for 10, but guess what? Target wants in again. And now let's say Walmart. Now Walmart wants to get in. They want to buy their socks. They are ready to go in and buy their socks. Price moves down yet again. So they can get filled. Now again, when Meyer gets in here, it's often going to take plenty of time for them to get into this market. They're looking for 100,000. So they need someone to sell them 100,000. Okay, and then they're ultimately looking to get back up and sell them for $10. Now all the way down here, a lot of people, and you'll hear them talking on CNBC, that's why I don't watch it much, they'll be talking about, oh, how we're due for a sell-off, and well, the economy's bad because the news was bad one day of the week, so that's why we're moving down. But the reason we're moving down, and this is what you have to understand, has nothing to do that the news was bad, has nothing to do with our economy is good or bad. All it is it's moving down because the institutions want to buy low and sell high. Okay, now the same thing works as reverse, right? They want to sell high and then buy low. So if I were to flip this thing upside down, you would see how it works on the sell side. And as the market moves up, everybody's saying, oh, you know what? Stocks are at a discount, and the economy is doing much better now. And by the way, as I do this update, it is May 3rd, 2011. Bernanke just came out last week and said our economy's not doing well. That's why he's not raising interest rates. But yet, the stock market and the market in general, if you guys have been watching, has been moving up. Has nothing to do with whether the economy is good or bad. It has to do with institutions wanting to sell higher. That is it. Okay, so this is an example of them wanting to buy lower. Now again, we see these areas within giving trading days. This could be also over trading week or a month. I'm going to show you an example here how we use it on a daily basis. Okay, so just remember, this is how the institutions work. Okay, now this is an example. This would happen to be yesterday, or whenever you guys get this update. This happens to be May 2nd, 2011. Our short, our resistance area, which we knew, and our members, we teach our members how to find those areas where the institutions are selling here, right? 67. This is the fair value of the market. This is where, again, when we talk about our socks, this is where we're going to have to buy 1 or 2 pairs of socks. Okay, but if the institutions we know want to buy lower, what does that mean we want to do? We want to short to them, right? So our first trade yesterday happened to be right around 9 o'clock here, as we were 67 to the downside. Now, when we talk about this, we had news at 10 o'clock, so we didn't take this trade here where we talk about buy levels. Okay, so we move down here when we talk about Meyer institution came in. What are they looking to buy? What is the number they're looking to sell their socks at? Again, we're talking about the market. I'm still going back to the analogy. So they drive price back up from their buy level back to the price at which they're selling their stocks. 67. What was our number this morning? 67. Now, what do we want to do once we hit that level? Knowing that institutions want to buy lower. They've already reached their max point. So we're selling 67 again. And the first thing we're looking for is what? The 62.50, right? Because we know that the Meyer institution is in there. Okay, we know that Meyer institution is in there. Now, again, it's not Meyer. Let's go back and talk about institutions. When we talk about institutions, the big boys, the Goldman Sachs of the world, a lot of the hedge funds, some of those funds that are trading hundreds of millions of dollars that can control and have the demand in the market. Okay, so here we go. We move back down to our Meyer area buy. What can we do there? We can buy, right? We can go long, and we look for our spike up, which we get. Now, by the way, at this time, what have we already done? How much money have we already made in this market? Right? Let's say here we only held for a couple points. This was pre-market, holding into market. We come back into 67, knowing that we're going to hold to about 62.50. That's almost 5 points in one trade. Now, we notice once we get back into Meyer's buying area, they try to bounce it up here. But we always, what we talk about to our members is we have to notice the strength of the bounce, because what we talked about before. Now, if Target says it wants to come in, we're going to move lower for those numbers. Now, with our members, we happen to know where our next number was. And it happened to be 57. We knew before the market even left this area that Target wanted to buy, the Target institution, by the way, quote unquote, because it's not really Target, but the next area institution was 57. Now we have the opportunity and the choice to make whether we short and take a short down to 57, or we just wait for it to get to 57 and go long, okay? So what happens, you can see here, so we move down. Here's our little bounce again, from the Meyer institution saying, hey, we're still buying there. But we always notice strength of bounces. And then our next move, we already know where it's going, and that's 57. Every day we tell this to our members. We know the numbers before they even happen. So we go to 57. Now again, we had the opportunity to either go short into 57. So from that 62 area, we could have shorted, or 61, anywhere in that area, and made a nice 3 or 4 point run, which a lot of our members did. But a lot of our members waited for that 57, and we're looking for a long because we know that's our next institutional buy area. Now, once we go long, yeah, do we have targets of 67? Of course we do, because that's still where they want to go and sell all their socks, if you will, that they're rounding up here. But we know that we also have to deal with these other resistance areas. So before, remember we talked about Meyer's buying area? That was our support. Now it becomes resistance. So we're looking right around the 62 quarter area as a resistance level in which we're going to either take profit and or short against. Okay? And so we can see that's exactly what the market does here as it moves up. We get into our 62 area. This is this institutional buy. And we get in, it goes back up to our first buying area, which is now going to be resistance. And that tries to hold down yet again. Now, at this point in their day, all our members have done. They've made a fortune for the day. I typically don't like trading after 3 o'clock personally. I do teach how to after 3 o'clock. But we move back down again into our buy area as we got back into the buying area in which the second institutions were buying. Nice little bounce. But I don't know how many points each of you are looking for in a day, but we had plenty. This was yesterday. The same thing is happening today as we speak. We had our short. Moved up to the next institution area. Shorted again to where it bought. So same thing happens on a day-to-day basis. This is how the market moves. You need to know that. Otherwise, you are playing against the institution. Okay, that's how the institutions are looking at blowing up your account. They know you're sitting at home, wherever you're sitting at home, watching your computer, and they know that you're trading your 1, 3, 5, even 10 contracts, and they're looking to blow you up. That's why it's important to play along with them rather than against them. So I hope this was beneficial to everybody. Thank you again for watching, and we'll see you soon.